The market is afraid that we're going to see some kind of hard landing, or at least quite forceful deceleration in China right now. That is reflected by the dramatically lower material prices and energy prices. Energy prices obviously is also a result of very large supply from especially the shale gas producers in the US. But overall, the market is pricing in lower growth rates in China. And also, and I think that's primarily what has happened since January, especially where the Chinese stocks opened the year by dropping 8% on a single day. It's all about China, that this deceleration is going to happen quicker than the market was expecting to begin with. And if they are going to devalue, and I think that is necessary for them because they are the Chinese renminbi in real, that means inflation-adjusted terms, has been revalued by 50 or 60% since 2007. So they have actually eroded their competitiveness quite dramatically since 2007. They need to devalue again in order to restore competitiveness vis-a-vis the Western economies. And I think that is what is being priced into the markets right now in the Western markets, that we're going to see devaluation in China, and therefore also they will be exporting lower prices or disinflation or outright deflation to both Europe and the US. And the market is perhaps also a bit frightened that if this is going to take place, that the Fed is going to hike interest rates nonetheless. Even though that would be a dramatic tightening at a time where the market is not really needs a tightening. Well, obviously the biggest threat is that we are going to see a hard landing in China, but I don't think that's going to happen because they will most likely devalue before they do. We see that, and also they are having a number of things that authorities can do. They can lower the required reserve ratio for the banking system. They can lower the interest rates. They can do more stimulus programs, which they're already undertaking. And we're also seeing that the money supply growth of the Chinese economy is again picking up. So these are early indicators that the Chinese economy is about to bottom out and then take off. I'm not saying that they will maintain growth rates of about 7%. I think this is going to decelerate in the longer term, so they will converge against a growth rate in the Chinese economy of 3 or 4%. So I'm just saying this is not going to happen over the next year. This is going to happen over a 5 or 10 year period. I think the best thing a long-term investor could do right now is actually to begin increasing exposure to the stock market. I think this is getting to be an overreaction. What we're seeing right now is the worst investor sentiment. It's actually worse than in 2009 when it was the worst. So this is really getting to be extreme. So investor sentiment has been dramatically deteriorating since in the past half year, to a degree where it's not really justified by what we see in the macroeconomic environment. Perhaps the most sensible way for a long-term investor to apply his capital into the equity market would be to buy 1/3 of what he's expecting to use in this month, February, and then 1/3 in March and 1/3 in April. This way he will not be dependent on the volatility of markets, but rather getting into to the most attractive prices without the volatility.